Hey guys, what's up? I'm Erin and welcome back to the channel. On June 7th, 2024, NVIDIA conducted a 10-for-1 stock split. Prior to the split, shares were trading for about $1,200 a share. After the split, price adjusted, the new price per share was about $120. A stock split is where a company increases the number of its outstanding shares to boost the stock's liquidity. While the number of outstanding shares increases by a specific multiple, in NVIDIA's case, 10 for every 1 outstanding share, the total dollar value of all shares outstanding remains the same because a split does not change the company's market capitalization. Essentially, a stock split divides existing shares into multiple new shares, but the total value of the company is left unchanged. Prior to their stock split, NVIDIA had roughly 2.45 billion shares outstanding at a price of about $1,200 per share. The market capitalization was roughly $2.94 trillion. Directly after the 10-for-1 split, there are now roughly 24.5 billion shares outstanding at a price of $120 a share. So the total value of the company was the same, $2.94 trillion. The thing that changed was the total number of outstanding shares, not the value of the company. Stock splits haven't gotten a great deal of attention in recent years, quite frankly, because they've become less common. In the past few years, the number of companies a part of the S&P 500 that have actually conducted stock splits has hovered around 10 or so. But in this year alone, we're seeing an uptick in these numbers. Some companies that have already conducted splits this year are NVIDIA, Walmart, Sony, and Chipotle. We're only halfway through the year and we've already had 10 companies a part of the S&P 500 announce their splits. Now, this is nowhere near the peak. Those peak split years for stocks actually happened during the dot-com bubble, and we would have somewhere near 90 splits a year, and that wasn't uncommon, but we're still seeing a noticeable uptick. And with these big market movers announcing their stock splits, they might be ushering this trend back into fashion. There could be a number of reasons that a company might execute a stock split. The first is increased liquidity. With shares trading at a newer, lower price, this can make the stock more attractive. The perception is that a stock is now more affordable, and that can increase demand and that can increase liquidity. Investors can now buy more shares with the same amount of money, and that can increase transactions. There's a big psychological appeal in this as well. Investors who once looked at this stock as being out of their budget might now look at it and say it's affordable. And psychological factors don't just play into the price. Say you owned this stock prior to the split. After the split, it might feel better to own more shares. For instance, if you owned 100 shares of NVIDIA before the 10-for-1 split, following the split, you now own 1,000 shares, and that might feel better to say. A stock split might also broaden a company's investor base for the same reason of affordability. When a stock price gets to incredibly high levels, it might not be affordable to smaller institutional investors or smaller individual investors. It might only be affordable to big institutional investors. So by bringing that price down, they kind of throw their hat into the ring and give broader market appeal to more potential investors. A stock split can be seen as a signal of confidence from the company's management, suggesting that they anticipate continued growth and strong performance. This positive perception can boost investor sentiment, and stocks that recently have undergone a split tend to see an increase in demand and this increased positive perception, and that can benefit current shareholders. And what I think is one of the biggest considerations for a stock split is potential index inclusion. Different indices treat stocks very differently. Two of the most well-known indices out there, the S&P 500 and the Dow Jones, treat stocks very differently. The S&P 500 is a market capitalization weighted index. Larger companies, those with higher market capitalizations, have a greater impact on the index performance. On the other hand, the Dow Jones Industrial Average is a price weighted index. Companies with higher stock prices have a greater influence on the index's movements regardless of their market capitalization. Let's run an example to see how these indices differ. First, let's look at the market capitalization calculation, like the method used for the S&P 500. Let's say we have a stock trading at a price of $800 a share, with a total of 2 million shares outstanding. This company would have a market capitalization of $1.6 billion. In determining how this company is valued on the index, you would look at its total market capitalization relative to the sum of all of the company's market capitalizations in the index. So if the total market capitalization of the entire index, collectively all the companies, was say $20 billion, in this case, this one stock would have a weight of 8% of the entire index. On the other hand, let's look at the price-weighted index, like the method used for the Dow Jones. Let's say we have that same stock trading for $800 per share. For the purpose of our example here, let's say we have 4 other stocks on this index, each trading at the following prices. In this case, this one stock would have a weight of 59.3%, so it would have a huge sway on the index. In a price-weighted index like the Dow Jones, a stock split can have a significant impact on the weight component of the index because it's based on share price. For the S&P, however, a stock split doesn't affect the index's weighing because it doesn't affect market capitalization. It's left unchanged. So for stocks on the S&P 500, there may not be this same incentive to complete a stock split. Being that the Dow Jones is price-weighted, a high share price alone might prevent a company from being included on this index. For instance, you won't find Berkshire Hathaway on the Dow Jones simply because of its price. By splitting a stock and lowering the price, companies can potentially become eligible for inclusion in these indices, and that can make them eligible to be included in more index funds and ETFs. And there is a certain prestige from being included in these exclusive indices. That's not to say it's the goal of every company, because quite frankly it's not. But for companies that do get included, they can notice a stronger demand for their stock. And that's simply because all of the index funds or the ETFs that track a particular index would then go out and buy this particular stock. Or for individuals who are interested in mimicking a certain index, they would go out and buy this stock. And in no way am I trying to say that the Dow Jones is better than the S&P 500. That's not true. They are different indices. They each have their own pros and cons. They're just different. The Dow is a much smaller index, including only 30 companies, whereas the S&P 500 is much larger, including roughly 500 companies. It's also worth noting that it's not price alone that makes a company or a stock eligible to be included in the Dow. There is actually a committee that presides over the Dow Jones and determines which companies are eligible for inclusion. And this committee will consider things like reputation, sustained growth potential, and overall sector representation, for example. There are also some potential downsides to stock splits that should be considered. Some investors might perceive a stock split as a sign that the company's stock has become too high and may signal a future price correction, and this perception can become a self-fulfilling prophecy and lead to some volatility. And this new lower price itself may increase volatility, simply because a stock at a lower price is more affordable to the masses, and that can increase trading activity, especially among short-term traders. Also, keep in mind that fundamentally there is no value change of a company that goes through a split. There are simply more shares now available at a lower price. The overall market capitalization has not changed. Also, this can lead to a perception of dilution of shareholder value. Again, keep in mind this is perception because the total percentage ownership has not changed, but with more shares, it can change the overall perception. Also, keep in mind that once a company goes through a stock split, there's going to be more eyes on the company and its stock and its performance. And if it doesn't perform well following the split, that's going to raise some eyebrows. If a company that pays a dividend goes through a stock split, the per share dividend amount will decrease post-split. The total dividend payout would still be the same, but some investors might prefer a higher dividend per share. Finally, administrative impact. A stock split isn't free. It costs the company generally a few $100,000s in fees. Think if you were to be able to refinance your home. You might be able to make your payment more attractive by doing so, but you can't do this for free. There is a transaction cost associated with it. And also, a split of a stock can make the analysis of a company and its stock a little bit more difficult. Stock splits certainly have an impact, and as we're seeing more companies complete them this year, these companies are making headlines and garnering themselves more attention. And it could be a situation of like attracts like. If more companies are completing stock splits, more companies may want to complete stock splits. What are your thoughts? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing.